All right,
This meeting is being recorded.
good afternoon, guys. So this is Black Business Excellence, March 2022. I want to thank everyone for coming and attending today. Just so you know that this recording will be posted to YouTube, so anyone will be able to follow up with it on Dubb Value's YouTube page. In the meantime, however, I would like to introduce our two keynote speakers. Jonathan Wilson, the President and Chief Value Creator of Dubb Value Creation, and Sornecia Pierre, the Banking Specialist of US Bank.
Yeah. Well, thank you, Colin. I really appreciate that. Colin, definitely it's been value having you on the team. Thank you for organizing this. As Colin mentioned, my name is Jonathan Wilson. I am the President and Chief Value Creator for Dubb Value Creation. We'll be doing a monthly series. We meant to do one last month. Unfortunately, I ended up losing my voice, so I will own that. We focus primarily on mergers and acquisitions, strategy, and we do it through a management consulting lens. So we work with companies of all sizes, primarily focused on helping companies win. So with that said, I'd like to introduce our special guest speaker today, Sornecia Pierre. Sornecia, do you want to introduce yourself? And I just want to say thank you again for joining. So we're very happy to have you.
Well, thank you for having me. So hi, everybody. My name is Sornecia Pierre. I am a business specialist with US Bank. I have been with US Bank for about 4 years now, but I've been in banking for about the last 8 years of my career. My background is in accounting, so both of my degrees are in accounting. And so it's natural that I fell into the finance industry. Right now, I concentrate on helping a lot of small to medium-sized businesses to either grow or just maintain or just ensure that they're financially sound. So I help out with anything from starting your business account to understanding your cash flow to understanding credit. So I'm happy to be here today. I'm going to talk a little bit about all of those topics that I just touched on, and just kind of providing some information in terms of how to maintain sustainability in your business and ensure that you get to the point where you want to be. I'm happy to be here.
Excellent. Well, thank you so much. Colin, do we want to move to the next slide? Excellent. So for today's agenda, we're talking about the significance of Black business. We will then go into visioning and strategic planning. Then we're going to talk about bank partnerships to address capital needs. We'll do think through some additional considerations that piggyback off of the visioning, strategic planning, and the bank partnerships. And then we'll do Q&A based on any questions that the audience may have. And that will be led by Ishmael Mew, who's also on the call. So significance of Black business. I'm not sure how many of you know, do you want to move on to the next slide? I'm not sure how many of you know that there are about 5.8 million employer-owned firms in the US, or employers. And then there's 2.3% of that is Black owned. So as you can tell, that's a much smaller percentage than the 14% population. So that's something that we really want to help change, I think, in today's society and tomorrow's society. The other piece of that is that the average Black wealth or average wealth for Black families is about $24,100 per Black family. And that's something we need to think through because that's about 1/8 of the majority Black families. So the other piece is too, I want to do a deeper dive though on Los Angeles, just because that's where we are located and it's something that's of interest. As you see on the left graph, thank you, Brookings Metro, 7,200 number of Black businesses. So that is 2.3% of the total business population. And then with that, keep in mind that 7.6% of the 7.6% of the population is actually Black in Los Angeles. So that's definitely something that we need to also modify as well. So let's do a deeper dive in Los Angeles. Colin, can you go to the next slide, please? Yeah, so here you'll see that the number of Black businesses, only if we could get from 7,200 Black businesses, which are the number of Black businesses in the Los Angeles area. If we can move that up to 25,925, we'd be at the parity for, which is approximately about 7.6 of the total employers that are in Los Angeles, which that's just a little bit moving the needle. The other piece is, if we look at jobs, if we were able to move the needle from our 50,000 current jobs within the Los Angeles area up to the 119,000, that we'd have 69,000 more jobs in Los Angeles area. Look at wages, right? So wages right now on average is about $48,700 that we pay employees within Black firms. If we're able to move that up to the $60,755 on average salary, which is the average per business in Los Angeles area, that could actually increase with a joint parity of about $707,000. I'm sorry, $707 million. And then on top of that, we look at the number of jobs that we're creating from the overall Black business population, from a status quo moving all the way up to parity. We really could have a total number of 379,531 jobs if we're to move up to parity for both the population and the number of jobs per Black employer. So I hope that wasn't too confusing, but this is really a deep dive in the importance of Black business, and we did a deeper dive in Los Angeles. So moving on to the next slide. So part of this actually happens by thinking about how do we bring in more Black businesses, and how do we help all businesses actually succeed? This is really something that anybody can really learn from in terms of visioning, strategic planning, how to attain capital. So let's do a deeper dive into how Dubb Value sees visioning and strategic planning. So we put together a methodology. Thank you, Ishmael. It's really focused on, discuss your scope and approach, right? So who are you as a business? Think about the you as in covering your strengths and weaknesses. So what are you strong at? And where are your weaknesses? You really want your weaknesses to be kind of neutralized while you focus on accelerating your strengths. The other piece is also looking at the breakdown. So breaking down your threats and opportunities, that's something that you always want to make sure you're thinking through as well. And then once you understand that a little bit more, you say, okay, how do I brainstorm some of my SMART goals and objectives? So by SMART, specific, measurable, actionable, realistic, and time-based. The other piece then moving down to validate. So you're validating your milestones and action steps. You're aligning your resources with the goals. So making sure everything is moving in sequence and in lockstep. You want to make sure you're learning and adapting. So your business is almost like any kind of being, right? As a human being, you're learning and adapting. Your business also needs to be learning and adapting. Continuous improvement is something that you always need to be doing. Updating, you want to make sure you update your milestones and future ways of working consistently. And you want to make sure you always embed best practices. So read as much as you can, learn as much as you can, gather as many details as you might need to be able to understand how to move the needle, not just for yourself, but also for the overall industry. Because the bigger the industry is, the better off you'll be, right? From a market share standpoint. And actually, if you can uplift others while you're doing that also, it's just goodwill that comes back to you as a business. So, with that said, I'm going to move on to the next slide. So environmental scan, so important to start off with an environmental scan, thinking about your total environment. What does the industry look like? How might I think about my different services that I offer on a tiered level? So make sure you're looking for what the market needs as well as what you're offering as well. From an organizational assessment, also make sure you're looking internally, just like you're looking externally from an industry standpoint and your service offerings and how it's faring in the marketplace. You're also thinking about the organizational assessment side of this. So, what capabilities do I have? What are my strengths? Where's the opportunity within my organization? Some of that might be driven through measuring through primary research, right? Through taking a look at what kind of feedback am I getting from my clients? What kind of feedback am I getting from my employees? Usually people tell you really where you need to go. And if they're telling you something very light touch, they may actually mean it to be something more of an impact than it is, right? So people have a hard time really telling you the straight truth, but they might give you a roundabout answer. But listen, whenever they give you feedback, always listen. And then customer segmentation assessment. So that's the other piece too. You want to make sure you're looking at your different customer segments and you're thinking through, okay, how do I address one tier versus another tier from a customer segmentation point of view? So ultimately, the idea is for you to understand what growth and profitability look like. So with that said, we go to the next slide. Here's an example of the strategic plan that you want to think through. Make sure you have the key result areas, your objectives, your goals. Every goal should have an owner. If you are a 2-person team, each person still needs to be an owner. If you're a 1-person team, put your name there, but it shows ownership and it makes you accountable. And it helps you actually want to put other people in that box. So you have objectives and things to think through. You want target delivery dates. You want to make sure you think about, at what point do I have this goal? Is this goal going to be completed? At what point do I need to be, focused on the next piece or next component for that piece of the strategy? Again, also think about your numeric targets. Unless you have a target, it's not really a goal. Again, so focusing on your target, also think about how you're going to measure that. So think about the units, think about what the metric is that you're looking at. Think about how you're going to calculate the metric, right? What is it going to be based on? And then make sure you're looking at the targets, the actuals, and the comments. So again, make sure you're writing notes to yourself in the comment section. And that's really the overarching look at that, but let's go step by step in terms of what each of the areas mean. The first area is a key result area. That's really something where you take a look at all the contributing areas for your company's operating model. You then focus on a critical group of summarized areas, right? So in this case, we focus on sales, marketing, servicing, delivery, financial performance, org development, and then technology and operations, right? So those are the things that we deemed as being important for this particular organization. We then looked at, how can I then confirm a list that helps me understand the health of the organization? Okay, well, yeah, this is probably how I would outline my organization. If sales are going well, but none of the other 6 are going well, then maybe I need to be thinking differently. If, on the other hand, if everything but sales is going well, maybe there's something I need to be thinking about. So this really will help you understand and prioritize what needs to happen. So many companies get focused on just tactical approaches and get focused on just numbers, but that's not really going to help you move the needle. That's not going to help you grow as an organization. That's not going to help you bring on new people. You have to have a plan. And your plan starts with having something written down and hopefully with targets and measuring your actuals, which measures your ultimate progress towards those goals. Moving on to the next slide. Maybe a technical difficulty. There we go. All right, so within each of the key result areas or KRAs, and keep in mind it's also, there are tons of books out there that talk about strat planning. So there should be, there's no real challenge with ideas. A lot of this stuff actually stems from past experience that I've had over the years, and then also from a book called Growing Pains. So Growing Pains definitely helps me understand a little bit more around what key result areas are, what objectives are, and moving through that. When you start brainstorming your objectives, what exactly do you want to accomplish as it relates to sales? Are you looking to just think about a number, or are you also thinking about how you mature the infrastructure? What areas are you thinking about marketing, right? I want to increase my awareness, increase awareness of my company, right? And also the organization's capabilities. I also want to make sure from outlining the importance is very important as well. So you might want to have several items within there, and they should probably be in order of importance as you think through the objectives. And then keep in mind while you may have them at first as being tiered, they all contribute to your model. So one thing can't be going wrong while all the rest, or one thing can't be going right, but all the rest are going wrong. You have to be really thinking about moving the needle with all areas at the same time. It's really hard to do because you get so caught up in the tactical pieces. But if you aren't learning how to fight fires while also growing your company, you will remain stagnant and you'll always remain behind. Moving on to the next slide. All right. Now this is more around the SMART goal setting, right? So specific, again, measured, achievable, realistic, and time-based. So you want to think through, if you look at each goal here, for example, the first one that says for enhancing tier 1 service offerings by growing services nationally to 300K annual revenue. So again, specific thing there is we're focused on tier 1 services. The measured part is we're thinking about the 300K annual revenues, right? Is it achievable? Well, make sure it's achievable for your company. For this company, it seemed like it was achievable. The other piece is realistic. So from the realistic standpoint, and also keep in mind that you want to be accountable. You want someone to be accountable for it. So is there somebody that can help me be accountable for this? Within the organization, sure. Is it something that is realistic for my company? Yes. The other side of it too is it time bound? Well, if you're doing an annual strat plan, that you're saying at a minimum, it'll be done by the end of the year. So that's where the time-based piece comes into play. And keep in mind, I guess, moving on to the next slide. So this is a good way to outline and keep yourself in check in terms of metrics and measurement approach. Once you create this plan going into a new year, you want to revise it over every quarter. Don't revise it every month though, because then you keep changing it, and it might as well be you just running the show by yourself. The other piece is if you look at target delivery date, you look at the numeric target, the target metrics, etc. Those will help you really think the measuring part of it, and you'll be thinking in your head as you actually are doing things. Okay, how is this moving the needle? How would I calculate this? How does it contribute to the overall success of my strategy? These are things for you to think through. So determine specific targets, and then identify where you're gonna get the source of truth. All right. So moving forward. On the next slide, please. Thank you. From a tracking approach, you want to make sure you have each of the months defined in terms of target. So yes, while you may have one overarching target, all of those can be broken down into the months of the year, right? So if I say 300,000 or 300 million over the course of the year, you want to think through dividing that by X number of months, understanding that there might be seasonality. Some months are good, some months are not. If you're in retail, January might be a slow month, so don't try to have high numbers in there, right? If you are, on the other hand, in a different part of the business, if you have a steady business focused on, let's say, consulting, January might be a good month for you, while December may not be a good month for you, right? So depending on the cycle, depending on the season, something to be thinking about. All right, so moving on to the next slide. And always, each month before you go into the month, you want to make sure that you have an idea, or as you go into months, you say, you want to have an idea of how you're going to achieve your goals, right? So if I have that I want to achieve $10,000 in the month of January, I'm going to be thinking through, okay, what are my steps to achieve that? I need to first make sure that I understand what my tiered offerings are. I want to make sure that I also am getting the right feedback, right? I want to make sure that I then finalize my offerings page. I want to make sure that I provide that preliminary estimate early on, and then I also want to make sure that I have those revenue numbers solidified, because it may be the first time I'm measuring this, right? So you got to make sure you give yourself a little bit of time to adjust to the strategic plan and strategic planning concept. So moving on from this slide, ultimately, you want to make sure you're creating a chance for you to be able to make modifications, test out your process, test out your ability to be able to measure success. So you want to have an initial meeting, I think, in the month of January to measure January's goals. Am I on track or off track, right? It's a yay or nay, right? So if I'm looking to achieve, let's say, $10,000 by the end of the month, and I only have $1,000 by January 21st, I might want to think about the hustle. Or if I already know the money's coming in, then maybe it's not a big deal. So give yourself an opportunity to be successful. Don't wait until after the month is over and say, oh, well, I guess I didn't make it. That's not something that's going to be helpful. That doesn't help your mindset. And that it's also not something that's going to help you understand when you do the push, right? If you have invoices outstanding, push yourself to get those invoices actually paid. So that's something you want to think through. The other piece is that month end update with actuals. Make sure your actuals in there. Make sure you hold yourself accountable by taking a look at what the original target was and pat yourself on the back if you did a good job. If you didn't, also acknowledge that. Don't beat yourself up, but think about what you're going to do differently in the month of February, for example. And then that conversation in February is going to be shortly after the month ends, after you have all your metrics in there or your actions in there. Then you think through, okay, what are my lessons learned? What am I doing differently? And definitely when you think of the action plan for February, incorporate that into the way that you're going to be executing. So again, you want to make sure you have that monthly cadence, if you will. So, rhythm to track your progress, your results, and then any best practices that you want to incorporate, and then whatever your new ways of working may be. And it's going to be an adjustment to create your strategic plan. It's not easy. It's not something that is done lightly, and it's hard to tackle all the things that life serves you. And if you're a parent or even if you're a caregiver of any kind, it's hard, right? This is not, they don't call it work for a reason. They also, it's being an entrepreneur is not light touch, right? So you got to be in, or you might see other consequences of that, right? So, in cash flow is one of the biggest things that you're going to be facing from a challenging standpoint. And so that kind of segues, I think, into the next segment, and that is around bank partnerships to address our capital needs. Sornecia, again, thank you for doing this. I'll let you take it away from here.
Thank you. I appreciate it. And I'm happy to be here. So we can go to the first slide. Thank you. Well, I introduced myself earlier, but then again, just so you guys know, again, I'm with US Bank. I am a business banking officer for US Bank. Been a business officer for about the past 4 years. Again, my background is in accounting, so I do have a pretty extensive knowledge of businesses, taxations, and all of the other stuff that's needed to succeed in my position and to help small businesses and other businesses grow. So if ever you guys ever, anybody looking at this wants to, reach out, you can reach me at my email, sornecia.pierre@usbank.com, or 310-294-6258 is my personal corporate cell. So I can be reached there. Next slide, please. So, I guess the first place you want to start after you've established your business, so you've gone to the register, you've registered your new LLC or your new corp, or you've started a sole proprietorship. The first place you always want to start is to identify a bank that you'd like to work with. Particularly, I work for US Bank, so some of these will be more tailored to US Bank offering, but you do want to choose your bank wisely. So think about all the things that you value when you look for a relationship. whether that's, what do they offer, whether it's proximity to your business or to your home, whether it's customer service. So there's a lot of things that you want to consider when you're selecting a bank, and every bank is going to be different across the spectrum. So that's why it's so strategic for you to really take your time and, deep dive into where do you want to start banking. Another big component of this is that, you want to establish relationships. A bank is not just a place that you're going to go deposit your funds and walk away, or you come in and you take money out. It's really going to be a partnership. And that's why you want to be very strategic about the bank that you choose to do business with for your business, even for yourself on a personal basis as well. So with US Bank, for the business side, we offer 3 main checking accounts. A unique part of US Bank is that we offer a free checking account for businesses. Most of the larger banks, they will require either a minimum deposit or a minimum balance in there at all times. With US Bank and our silver checking account, it does not require a minimum balance. It is technically a free checking account. And I say technically because if you decide that you want to get bank statements in the mail, they'll charge you $5. So that's where the technicality comes in. But a unique part of US Bank is that we do have a free checking offering. And, I do encourage a lot of small businesses to take advantage of this, because as a small business, every cost counts, whether it's $10 or $15 that you're losing on a monthly basis, that could be $15 that you can put back into your overhead costs. So having that free checking option, it is very beneficial, especially if you're in the starting stage of your business. After that, once your business is more developed and maybe you have a larger cash flow or you need a more substantive bank account, we do have the gold checking account. There are ways to ensure that you do not get fees on any of those accounts, and the same goes for the platinum checking as well. So all of these accounts is just based on what phase of the business you are, whether it's at your startup, your growth, or you're just kind of maintaining because you've already built your entire business, and at this point in time you're pretty stable. So we do have a checking account for every offering. Again, it's very important that you select the bank that you want to be with very strategically and make sure that they're hitting the value components that you're looking for. Next slide, please. All right, so you've selected your bank, you've started your business. Another key component at the beginning stage of every business and at any stage of any business, and Jonathan mentioned this earlier, is understanding, your cash flow cycle for your business. And a cash flow cycle is essentially the movement of cash throughout the business. So when you think about a business, think about your raw material, the first part of your business. And this can be for any type of business, whether it's a service, manufacturing, or whatever the case might be, right? So let's say, for instance, you are in a manufacturing business. And so the first stage of the business is going to be attaining the raw material. That's your starting point. When you think about a cash flow, think about what it is, how long is the time frame that is going to take you to move that raw material to the point where it produces profit for you, to the point where it produces cash back into your pocket. So you have to first get that raw material, turn it into a product, sell that product, and then get paid. So the cash flow cycle is going to look different for every business. Some business may be 15 days, others may be 30 days, some may be 60 to 90 days. Understanding a cash flow allows you to understand how your money movement is going to go, and it also understands you to make more sound decision on the money that you actually have within your business. Are you able to spend $15,000 today and still maintain for the next 30 days, knowing that you're not going to have anything coming in? Or will it be beneficial for you to spend $10,000 or $5,000 instead to ensure that you have enough cash flow to take care of all the other expenses that comes in with your business? So understanding your particular cash flow is extremely important in any business and at any stage. So this is a really critical part of the business. I talk about this part with nearly every startup because I think it's very important for every business owner to have a great understanding of what cash flow is. And this is a point that most owners don't understand. I always say that people come in for cash when they need it, and they don't set themselves up for, the point of basically not out in the fire when the fire already started. So you have to basically set yourself up so you're not putting yourself in a position for jeopardizing your business growth, and just ensuring that, once you understand your cash flow, you're putting things in place to maintain that. So that's the second part of the business. After you've selected your business and you've actually opened your checking account, is really deep diving into your business and understanding how long it's going to take from the point of production or raw material to the point of sale and money back into your pocket. So this is very strategic, and I'd like every business owner to really deep dive into here. Next slide, please. Okay, so to manage your cash flow. So again, you've just gotten an understanding of what your cash flow is. Now, there's a lot of ways that businesses can manage their cash flow. Once you understand what your cycle is, whether that's a 15-day cycle, a 30-day cycle, a 60 or a 90-day cycle, there's things you can put in place to ensure that you're managing that cycle. So for instance, let's say you have a 30-day cycle, and you have to pay for your raw materials at $30,000. Within that 30 days, however, you still have to pay payroll. You may still have to pay rent. You'll have to pay electricity, light, and everything else. Will you then take that full $30,000 from your bank account and pay it out and not know how to pay anything else, or not have the liquid assets, or whether it's credit or cash or anything on hand to take care of everything else that's necessary to keep your business growing? So to ensure that you have that in place, you want to make sure that you're managing that. And, we have a lot of products and services available to manage your cash flow. So one of the biggest things that you need to understand is to know your break-even point. Knowing your break-even point is your point of profit. So you'll hear business owners say, sometimes they're a year in and they'll tell you, hey, I still haven't made a profit in my business yet. And that's because their upfront interjection or injections for the business is so high that it'll take them a longer period of time before they even see a profit. Knowing when you actually see profit in your business is extremely important to knowing how you're going to manage your cash flow, because that means that you're going to be very heavy on cash going into the business and very light on cash coming out of the business in the first year. So you always want to make note of when your break-even point is going to be, or your profit point is going to be in your business. So keep note of that. The second thing, and I mentioned this before, is to secure credit ahead of time. Don't wait for the fire to happen to try to out it. Be a little bit more proactive and not reactive. So talk to your banker. If you're comfortable, and you should always be comfortable talking to your banker, get in there. Once you start your business, then you're in that position of your business lifespan where you can qualify for any type of lending, whether that's a cash flow manager, as we call it, or a line of credit, or whether that's a credit card. Get them and put them in place. Having credit doesn't necessarily mean that you're in debt. You don't have to use it. You can literally just secure yourself and have it there in case of emergency. But what you don't want to do is to get to a point in your business lifespan where either your financials are not strong enough or you're not able to actually qualify for credit to try to look for credit. Because that's when you're going to get those no's, and you're going to get the, you do not qualify, and then you end up in a little bit more of a financial catastrophe than you want to be in. So secure credit ahead of time when you can. Get it while you can qualify for it, and don't try to get it when you actually need it. Because I think that's kind of setting yourself up for failure. A third part of this is, talk to the experienced business person. Talk to other people who's been in the business that you've been in. Learn from their mistakes. I know Jonathan mentioned ahead of time that he said a lot of the pointers that he was, giving you guys earlier was based on his personal experiences. That's so strategic, because they can tell you where they went wrong, especially if it's in the same field that you're in. Learn from people who've been there before. Take advice, and don't think that, hey, I'm experienced, I know this. You may have a great background and a great education, but you do not know what you don't know until you get into the actual industry and you get into the nitty-gritty of things. And I think it's so strategic that we understand that we can learn from each other. So talk to people who've been there before, and really take in and soak up as much as you can, and ensure that you're not falling into the same traps that they fall into. And that way you can ensure that you're maintaining sustainability for the business. We can go to the next slide. Another big part of maintaining cash flow is understanding what your business needs are going to be. First things first, I always tell people, keep proper books. You don't know if you're making a profit if you don't have any way to gauge what's going in and what's going out. So if you're spending 30,000 and you're bringing in 15, but you have absolutely no paper trail, no records, no nothing, how do you show me that you're actually making a profit or you're making a deficit? How do you know that any of this is accurate? So keep a paper trail of everything. Invest in a small software, maybe QuickBooks, maybe Intuit. If you're not a professional, you don't have to be for most of these smaller software, but you can hire somebody at a lower cost. But it's important that you keep a paper trail and you keep proper records of your business, especially if you intend on expanding. And then utilize services like ADP for payroll. If you're not 100%, great on, keeping track of timesheets and, all of these things that could cost your business a whole lot in the long run, invest in smaller businesses like ADPs and QuickBooks and stuff, just to ensure that things are running well and that you're able to keep a paper trail of everything that's happening within your business. The worst thing that you want to do is to not be attentive of what's happening in your business, and then you catch the fact that you're running at a deficit when it's way too late to even, you have to be reactive and try to see how you can save it instead of you knowing, where your business is at every step of the way. So make sure that you're investing in smaller tools that can help you really see the potential of your business and really help you grow. These may look like upfront costs. I can tell you that most of these, especially as a small business, they are tax write-offs. And so you can save at the end of the year with them. So don't think of it as an expense. Think about it as an investment into your business. So I always tell my small business that if you're paying ADP costs and you're paying most of these software costs, you can write them off as the cost of business at the end of the year on your taxes. So be strategic in how you utilize these tools and ensure that you have things in place to, just kind of know how your business is going at every step of the way. We'll go to the next slide. So a lot of these are just other ways in which that you can, pay attention to your cash flow. I'm not going to go through all of them. I know we're on a time crunch, but, scheduled payments, that's a big thing. When they say scheduled payments, don't try to pay everything all at once. I think that's a big issue that I see with a lot of small businesses too. And a lot of people who are very scared of debt tend to do that because they always think, oh my God, I have this debt on my head. Don't think about it as that and don't feel pressured to paying everything off and paying it in bulk. So let's say, for instance, you have 4 credit cards and you may have 4 credit cards and a truck loan and your payments every month is, $6,000. And every month you take $6,000 and you pay off that bill knowing fully well that you may only have $1,500 left in your bank account. That's not necessarily the strategic best way to do it. And it might be better for you to pay one now and make sure that you have enough cash reserves in your bank account in case of emergency and pay the other one maybe 2 weeks after that. So don't ever feel obligated to pay off all your debt and go through all your liquid cash in your bank account simply because you're scared of debt. Debt is a natural part of running a business. There is no business that does not incur a cost, right? So you can't look at debt as this, black shadow of a cloud over your head, and then because of fear of it, you end up going through all of your cash or your liquid cash on a monthly basis, and you're forced to pay everything off. Don't do that to yourself, please. Be very mindful of how much money you have in case of emergency. What's your backup stash looking like? You never know what can happen within a business, and so you always want to ensure that you keep enough cash on hand in case an emergency is to happen. So don't feel pressured. Schedule your payments. And then again, it's just keeping up with cash coming in. This is a part of what we spoke about earlier, making sure that you have proper track records, making sure that you invest in some type of good program or software, or again, whether that be QuickBooks. I love QuickBooks personally, especially for small businesses. It's very intuitive. And a lot of it is pretty self-explanatory. Once you get in there, everything's kind of bubbled out and laid out for you. So it's pretty easy to follow. I recommend QuickBooks for a lot of small businesses, and it's been very helpful. So again, keep track records of everything, whether it's cash going in or cash coming out. Okay, next slide. Leveraging credit. Okay, so again, this is a big one, especially for people who are scared of debt. A lot of the times what happens is a customer comes in to my bank, especially, and they'll say, hey, I'm in a little bit of a financial debt. I had a tough year last year and I need some cash. And by the time they get to me, they're either $40,000 worth of debt on their hand already, and the business is kind of, not doing so well in terms of productivity. And a lot of lending comes down to what's on paper, what's black and white, So you have to be very, very wise on how you leverage your cash. And so ensuring that you get it at the right time is very strategic, but also ensuring that you get the right type of credit is also very strategic. So there's a couple ones. Credit cards is a no-brainer. I always tell everybody, get a credit card. You can't go wrong with a credit card. card. People are scared of credit card. I love credit cards. I do not use my debit card on a daily basis. Honestly, I use my credit cards for 90% of my purchases. And here's why. When you charge anything on a credit card, you limit the risk and liability on your end. We all know that there's a lot of crimes and scams and everything going out there, right? When you put your debit card online or you slide your debit card at a counter, you're more susceptible to being a victim of some type of fraud happening. Once that happens, that's your hard cash that's being, dealt with. That's your hard cash that's being held up. I prefer a credit card because I can always call the credit card company and say, hey, this happened, and I have no fear of my actual, hard cash being, taken away or being lost in space or not being able to, get that cash back. So I do that. Second of all, 90% of credit cards out there has some type of rewards. I personally love to travel. I utilize my credit card a lot for the points that I get for traveling. So every time I have a major purchase or even a small purchase, I put it on my credit card and I pay it off within 10 days of the cycle closing. What that does for me, I do not pay an interest at all, but I still get my points on the back end. So utilize credit cards. Don't be scared of it, especially if you have solid credit when you start your business. You can get a credit card from day one of actually establishing your business. And this again, may be a U.S. bank policy, but at U.S. Bank, if you established your business yesterday, you can come in to me and I can open up a credit card for you today. You do not need to have time in business. It's a very unique product in that capacity. Most of the lending products require you to be in business for at least 2 years. Credit cards, they don't require any time. You can be in business for 2 hours and we'll give you your credit card. So again, credit cards is one of the best ways to start building credit, and it can be so beneficial to you, and it limits your liability out there as a business owner. So as much as you can, get a credit card, get something that you love, whether it's cash back, whether it's gas rewards, whether it's travel rewards like myself, and utilize that credit card. Another unique part of credit card is that once you get a business credit card, and again, this may be unique to U.S. Bank, the actual obligation does not report to your personal credit. So if you, for instance, have started a business and you decide, okay, you know what, I need to buy maybe equipment or something, and you utilize your personal credit card to do that, that affects your personal credit. And we all know once you pass 30% on any credit, it kind of affects your credit score. Your credit score starts dropping. It starts declining because right there you increase your actual ability to spend. So once you increase that availability to spend dollar, it reduces your credit score. With business credit card, it does not report to your personal credit at all. I make a joke that it's a great way to hide debt because you never see it unless you default on it. So a business credit card is also a great way for you to just kind of separate those two things. Also make sure that you don't affect your personal credit and that you're increasing your debt too much, and again, it keeps your business just solid and, minimizes risk. At U.S. Bank, we have a platinum credit card. We have a gold credit card that's now called a triple rewards credit card, actually, and a leverage credit card. Most of our credit cards do not have annual fees to them. The only one that has an annual fee is the leverage credit card, but it offers exceptional rewards. It's a great card, honestly. The annual fee is only $95, but most of the times the reward that comes with it is actually, it outweighs the fee. So I always say, get it whenever you can. Don't wait until the end. Next slide, please. So lines of credit. So another way that you can manage your cash flow is to utilize a line of credit. Now, when you think about a line of credit, it's basically an evergreen product. Think about a credit card, except it's hard cash. So once you apply for it one time, you don't have to apply again. It's one of those things that's available to you whenever you need it, as long as you keep it open. U.S. Bank offers something called a cash flow manager, which is a line of credit. Now, across every bank, they may call this differently. Most banks may just say a line of credit. We call it a cash flow manager. So a cash flow manager is great for short-term lending. So let's say, for instance, you are waiting for payments to come in because your terms of sale may be a 30-day cycle or 90-day cycle or 60-day cycle, but you have payroll to pay within that 30 days. A line of credit is amazing to use for stuff like that. So it's meant to be kind of like a short-term lending type of scenario. You utilize it and you're meant to pay it back within 12-month span. So it's great to fill in the gap with a line of credit. So that's one of the best products I always say I recommend to fill in the gap when it comes to working capital and just, making sure that you have sufficient cash on hand to keep the business going. So that's different. So you have another great reason for it is, seasonal purchases. A lot of businesses at certain points, let's say for instance, you're in the retail industry, we know there are peak times in the year where you have to probably buy 2 and 3 times worth of inventory. You may have to buy, just making sure that you have enough products on hand for that time of year. Line of credit is good to utilize for stuff like that. Again, you can go into the bank and just say, hey, can you put $20,000 into my checking account? It is not considered a cash advance because it is a cash line. But it gives you that availability to buy all those products and get 3 and 4 and 5 times the amount that you buy, on a regular basis. And sometimes when you buy larger quantities, you're able to secure larger discounts. So you want to take advantage of that. And a line of credit is great to use for that in that capacity. Again, just ensuring that, you keep the business going, whether it's overdraft protection, that's another big one. Some businesses, they don't pay attention to their checking account. They're writing checks quite often. If you want to ensure that, none of your checks are bounced, none of your vendors, all of your vendors are paid, a line of credit is a great product to utilize for that type of reasoning. So the other product after that I was going to consider a term loan. So a term loan is what it is. Everybody knows what a term loan is. So at some point in time, you've probably taken some type of loan at a bank, whether it's on the personal side. Term loans for businesses works exactly the same, except that it's under the business. The difference with a line of credit and a term loan, I always say, if you know exactly what you're going to do with the money, let's say, for instance, you're going to buy a car, you're going to buy equipment, you have a specific use for that money, you want to use a term loan. For a couple of reasons. Term loans tend to be lower interest rates than lines of credit. Lines of credit tend to be slightly higher. Not a lot, maybe 2 or 3 percentile, but it tends to be a little bit higher. So if you know exactly what you're going after, you want to utilize a term loan. A term loan has also a locked interest rate, whereas a line of credit will have a variable interest rate. So, you don't want to, if you're making a big purchase, for instance, and hey, I'm going to pay $40,000, $50,000 for that product, you don't want to utilize a line of credit knowing that the interest rate can probably fluctuate on you at any given time. A term loan, it's a locked interest rate, it's a locked payment, and you know exactly what you have to pay every month. And so there are certain reasons that you would want to use a term loan over a line of credit or a line of credit over a term loan. So again, get a banker, get somebody that you're comfortable with, get an experienced banker, talk to them about the needs that you have, and then you can decide which product is going to work best for your need. But a term loan is also a great way to ensure that you're paying attention to the business cash flow. Again, you can utilize it for purchasing equipment, refinancing title equipment, or, just general business needs. But what that does is ensures that you always have cash on hand to kind of keep the business going. An equipment loan, it kind of is what it is. Again, you don't want to go through, if you have $40,000 in your bank account, your equipment costs $35,000. You may not want to take $35,000 cash and just go put that down, because you never know what can happen to your business at any given time. So keep that cash on hand, utilize the banks, utilize credit, and get an equipment loan and make your monthly payment, and ensure that you always have cash on hand in case of emergency. Next slide, please. All right, so now that you've kind of understand a little bit about cash flow and some of the products that we have, if you go into a bank, this is what we're looking for, the 4 C's of credit. So whenever you run your credit to apply for any type of lending, any type of credit product, this is what the banks are looking for. The 4 C's of credit is basically character, capacity, capital, and collateral. I'm sure most of you guys have heard it before. So this works on the personal side as it does on the business side of things. 90% of the times when you go for a business loan, they are going to run your personal credit. They will not run your business credit. There's very few businesses that can do standalone lending, and those have to hit certain requirements and certain, they have to fit in a certain box in order for you to do standalone business lending. So I will tell you, from the 3 banks that I've worked for, whenever you go in to do a business loan, they'll check your personal credit as well. They want to ensure that, you're not a high risk if they were to give you, whatever it is that you're requesting. So always pay attention to character, capacity, capital, and collateral. So your character is basically, how responsible are you? Are you paying your bills on time? Do you have 30 days late? Do you have bankruptcies? Do you have anything of that? So that's what they look at in terms of character. When we talk about capacity, it's your ability to pay back. Are you asking for a loan way higher than what you're actually able to pay? So if you're making $1,000 a month, but you're asking for $1 million loan, your capacity to pay doesn't really align with what you're asking for. So that's kind of, what capacity means. Capital is kind of your net worth, overall picture. What do you own? How is the business working? What's revenue looking like? They take all of that into consideration. And collateral is, if, for instance, you're buying a truck and you're telling them the truck costs $100,000, but it's from 1962, chances are that collateral doesn't necessarily add up to the cost of the actual product. And that's what collateral is. We can go to the next slide. All right, so this is just a high level overview of what we just went through. Again, character. You can, this deck would be available to you guys, so you can, pay attention to them a lot more details. But, we want to know that we can trust you. That's essentially what it is with character. If you've had a bad track record of not paying everybody else, why should we trust that you will pay us now? So that's the character. So it's very, very important that, you keep both your personal credit and your business credit very clean. I always tell people one late payment does more harm to you than, probably 3 years of great payment. So I have a running joke with my friends and I say, hey, borrow that payment before you miss that payment, because that's how bad it affects your, your lending capabilities. So that's what character is, and again, capacity. We just want to ensure that you're able to pay it based on the money that you have coming in. You can't be upside down on any of your lending products. Next slide, please. Capital, again, along with your monthly income, we want to see what else do you have. Do you have anything of value? Do you own a home? Do you own cars? Do you have a bank account that maybe has some substantial cash in there? So you want to know that you have the ability to own larger valuable things before we deep dive into that one product with you. So we want to look at your capital. We want to know that, in the event that this loan goes left, we might be able to salvage something and not lose everything. And then again, collateral, we want to ensure that whatever it is that we're using as a security for any loan that you're taking, the value is actually there. If, for instance, you buy a car and we give you $70,000 for the car, if for some reason we have to take that car back, we want to ensure that we're not going to be at a negative by the time that happens. So that's essentially what we look for when we're looking at credit and you do a credit application. And this goes for all lending types. We will run your credit and they want to see that you have, more than likely a cleaner credit. So want to keep that in good faith and good tact. So before you go into any bank to apply for credit, I always tell customers, look at your credit score, see where you're at, make sure that everything is accurate. It is free to request a copy of your credit report. Request that ahead of time if you know you're going to go into a bank and ask for any type of credit product, and take a look at that and make sure that everything is on the upside. And if it's not, maybe it's something that you can dispute, or you want to look more deeper into it and see whether or not it was actually your delinquency or your debt or anything that's causing any type of delinquencies on there. Next slide, please. All right, and this is just the basic, you'll need to qualify. So whenever you go into a bank, they're going to ask for some basic stuff, right? We all know that every bank, in order to get any type of lending, you'll need a social security number. That's because, again, we use your social security. We use your credit scores and everything to get you approved. So you must have a social security number. They do not take ITINs or any of the others. Business revenue is key. They look at your business revenue. So I always tell people, have conversations with your CPA before you go in for big lending. CPAs are meant to save you money. That's just the code of the game, right? When you do your taxes at the end of the year, they want to see how much deductions they can get and how little taxes you can pay. That's just how they operate. But when you come to the bank, they want to see how much revenue you're showing and how positive and profitable the business is. So they're operating on different end of the spectrum. So if you know that you're going to go for major lending, talk to your CPA ahead of time and show that you're not running a negative income every month. Make sure that the business is actually looking like a profitable business. Employment history is another big one. If you're constantly bouncing around, if you haven't been employed in the last 10 years, it looks a little bit risky. They want to know that you can commit to certain things. Checking your savings account, again, but from the beginning, I said, when you choose a bank, it's a relationship. When you have a checking account with a bank and you apply for credit, they look at your checking account. They want to see that you're not overdrafted every month. They want to see how your money's been coming in and out. If you're saying you're making $100,000 a month, but we're only seeing, $2,000 in deposits, something's off. So they're going to do a little bit more deep digging in there. So treat your bank as a partner, treat it as a relationship, because know that they will look at checking and savings as well. And just information on outstanding loans. Sometimes we do request that when you come in to do lending, because they want to make sure that your DTI is not too high, and that's a big factor. You want to keep that under 40% at least, and so kind of pay attention to that as well. Slide, please.
Great. Well, that was.
I think we're there. All right.
I think rather than going through additional
Thank you.
considerations during the time, we probably have one. We probably have room for 2 questions, maybe. Let's go to the Q&A, maybe. There we go. Let's go to the in this. Maybe I don't know, Ishmael. Are there questions for maybe there's one for me and maybe one for Sornecia?
Yes. I actually got a bunch of questions, but I'll choose one. Let's start with you. Someone asked, do you have industry metrics that we can use to evaluate our spend? For example, marketing spend as a percentage of revenues?
Yeah, that's a tough question, but yes, to a certain extent, we actually have, given that we've been operating for 5 years as Dubb Value, and then prior to that, I have about 17 years of industry experience working in consulting. So, there are references just in terms of P&Ls. So that's typically what I would do, is I'd look at what past businesses that I've worked with are doing. I'd also work with Ishmael and Colin on businesses that we're working with currently, and just kind of understanding what good looks like. And that may vary by industry. It also may vary by size of company as well. So, but yes, we definitely have metrics around that. And if you want to call us or email us, please feel free. We'll be able to have a deeper dive with you.
Thank you so much, Jonathan. And for you, Ms. Nisha, someone asked, how does past bankruptcy or personal credit issues impact your ability to obtain loans or lines of credit for the business?
So I will tell you, especially for US Bank, again, we do not do lending for anyone that has actual bankruptcy still reporting to their credit report. Now, after 8 years, they will give it consideration. After 8 years, they'll give a consideration. But if it's still on your credit report, 9 times out of 10, it's going to be an automatic decline. And that actually goes for the past bank that I worked with as well. That's why I always tell people, yes, bankruptcy may look like an easy way out, but think about it deeper and see if there's other options before you actually file, because it does affect you for most times about an 8-year period if you go after big lending in traditional banks, that is.
Thank you for your answer. I'm sure.
It looks like we might have time for maybe one more question before we close out.
Okay. Okay, then I'll ask you one more, Jonathan. Someone asked, can strategic planning work for non-for-profits? And if so, what are some of the things to consider?
Oh, absolutely. There's a lot of, just like you run a for-profit business, you can run a not-for-profit business. I think the key is, and I have been on boards, I've worked with various nonprofits from a way of working standpoint. People say, oh, well, we're just a nonprofit, you can't expect the same things. Well, to a certain extent, you can, right? The way that you run your organization from an optimization standpoint with generating, let's say, donations, or thinking through how you actually manage your people, or thinking through the various functions from an operations perspective, facilities perspective. There are different ways that you can incorporate strategic planning within your not-for-profit business. And again, happy to help you think that through. Please feel free to email me directly. You can also email info@dubbvalue.com, and someone will get back to you shortly. Our general phone number is 424-380-4277. Thank you for that.
Thank you, Jonathan. That'll be all.
All right, guys. Thank you to both of our panelists, Jonathan and Sornecia, for taking the time to be a part of this today. And I want to thank all of you for attending our first ever webinar series. This will be a monthly series where we'll be tackling different topics throughout the rest of the year. So please be on the lookout for our invitation for our April conference, which will be towards the end of the month of April. Thank you very much, guys. I really appreciate all your time, and I hope you all have a good rest of the day. And just a reminder that this video will be uploaded to YouTube on our YouTube channel at Dubb Value. Thank you guys so much.
Thank you. Sornecia, so great.